So all the way on the left, we have Bart Smith. He's Global Head of Digital Asset Strategy at Susquehanna. Bart, good to see you. We've also got Blue Macellari. She's Head of Digital Asset Strategy at T.Rowe Price, a position you just started a couple months ago. Congratulations.
Thanks.
And right here next to me, I got Puneet Singhvi. He's Head of Digital Assets for Institutional Clients Group at Citi. I just want to start by taking a poll, informal poll, everyone who's eating right now. Raise your hand if you have crypto in your personal portfolio. You guys included too, by the way. Okay. Just making sure that we're, on the right page here. Blue, I want to start with you because we heard Michael talk about cycles just now. And we're in a really weird place because it does seem like each and every day we get some huge news about some traditional asset manager wanting exposure to crypto, or BNY Mellon coming out and saying, we'll be custodians for crypto now. At the same time, $2 trillion in crypto wealth has evaporated in about a year. Where are we?
So I think it's really interesting because I had been in traditional finance and I left 5 years ago to go to a crypto native startup. And I started right at the beginning of the last crypto winter. So our first track record day was January 1st, 2018. And within months, the whole space had just a lot of it had evaporated. There were, desks that were closed at banks. Institutions pulled back dramatically. What we're seeing this time is that even though we're in another crypto winter, and we've obviously had this, this big drop in market cap, the institutions are still committed and moving forward with plans. And we saw the announcement yesterday from Bank of New York Mellon, which everyone knew that they were working on this, but the institutional commitment is there in a way that it wasn't in 2018. And I think it is no longer, depending on who you ask, it's no longer an existential question on will crypto cease to exist?
Why is that institutional commitment here now and it wasn't here in 2018?
I think that it was such a new technology and a new space, and we saw what looked like a significant bubble, a run-up, and when the bubble burst, and the floor back then in 2018 was we're talking 6,000 as a price point for Bitcoin, so it was a huge drop, and I think a lot of people who were already skeptical said, okay, this is it, crypto is going to cease to exist. I think that institutions and the market more broadly has seen the way in which I think it's largely driven by retail and by have embraced this and continue to stick with it. And I think that there's a real generational piece that people are starting to recognize as well.
Bart, jump on in here because you started in the current position that you're in, which is Global Head of Digital Asset Strategy at Susquehanna, December of 2021. So right as the air was starting to come out. What were the conversations that you guys were having about sticking with this versus saying, wait a second, this might not be something we should do?
So I was involved in kind of the 2016, 2017 phase. The firm has been involved in Bitcoin in particular for a long time, mostly just buying it proprietarily in kind of 2014, 2015. We did have a build out in 2017 of a desk that was providing liquidity for retail platforms and some limited institutional customers, the limited few that were there. And really what we've seen is this infrastructure being built out, right? So there's a lot of institutions, pensions, endowments, foundations who don't want to or can't practically use crypto native infrastructure, right? So even something like Coinbase, which is a very well-known name, it's listed, on the equity market. If you work at a pension or you work at an endowment, getting that on as a custodian is like a Herculean task. And so when you see firms like Bank of New York Mellon and State Street, with BlackRock announcement that they're going to have it on the Aladdin program, which the vast majority of institutions use as a critical piece of infrastructure, I think that's the piece that in Blue's comments that is different now. I've wanted to invest in it, but I don't want to have to set up new vendors and new fixed line connectivity. I don't want to have to get new software. I can't use a non brand name custodian, and all of those solutions, while they haven't fully fixed themselves, you can see it on the horizon of that infrastructure being usable.
But Bart, where's the drive coming from? Is it coming internally or is it coming from clients externally? Like clients, and then of course their clients want access to it. Is that what it is?
I think that I think you're seeing from our perspective, right? Because we obviously trade in the spot markets, we trade in equities, but the kind of bread and butter of Susquehanna is derivatives, right? Futures and options. And you're seeing a world where, when you get to like a real kind of bona fide prime brokerage solution, where I can not only, cross margin my collateral for different crypto products by asset class and by investment type, like so options and futures, where in the equity markets or traditional markets, they're all fungible. Now you're talking about real scale, and you're seeing real institutions who can do strategies, and it has the liquidity that they would need for like a Brevin Howard to run a macro fund or a D.E. Shaw, and these brand names. They're not going to mess around in an asset class where they can get like $50 or $100 million of liquidity when they need $1 billion of liquidity. And there's partners out there now like Susquehanna who can provide that. And so as these infrastructure things continue to get built out, you will see the types of strategies that people can run right now are growing. And like the whole world is driven by macro, right? Like every headline, whether it's interest rates or central bank activity, it's just driving everything. And like what a great high beta way to express your opinion in that space than trading Bitcoin derivatives and options and running strategies that you would typically run for commodities and currencies in this asset class. It's an amazing asset class as far as efficiency to express a view that way. And now you're seeing firms like ours who can provide liquidity that provides the infrastructure for them to do it.
Puneet, how are you thinking about this at Citi? I mean, you've been at this firm for what, 20 years in many different roles. This is a relatively new role for you.
It's very fascinating kind of how this brings everything together, from payments to trade finance to foreign exchange or custody, and very uniquely. What I find very fascinating here in this space is just from a capability perspective. So one whole side, I mean, obviously the whole size is about $1 trillion. The global financial markets are a few $100 trillion. So when you think of pure capability lens of it, does it provide new set of capabilities which could actually enable additional efficiencies, functionality into traditional markets?
So,
and do we expect like this crypto to run in parallel? Do we actually see some level of overlap between the two?
So you're talking about underlying technology that helps TradFi.
As one of the components.
What does that look like?
Yeah, so if you think of traditional component here, you think of Ethereum. This is one platform where you have money, you have different forms of assets. In traditional markets, we have different systems and different infrastructures supporting different components of the financial markets. Also, which is very distinct between different firms. So if you have one platform which could actually bring money together with securities and could actually enable new ways of settling, a new way of communicating between different institutions, that could be pretty unique. Now, obviously, we are in the early stages of all of this. Technology scalability is an issue because it is not as scalable as some of the centralized infrastructure is. It is not as robustly tested as some of the current infrastructure is. But we are in the initial stages of a multiple POCs, which I call as tokenization. Tokenization of collateral, tokenization of private funds, and you saw the announcement KKR made recently. Very initial days. Collateral, tokenization of real estate. And a lot of real estate assets are tied up in illiquid form. Could we actually have a way in which we can drive liquidity in that? So bonds, and typically bond sizes are very large. Could we actually fractionalize them in a more efficient fashion for retail customers to access? All of those are use cases which we are looking at.
Is the government going to let you do this?
Yeah, obviously it has to be in a very well-regulated format. The risk tolerance of regulators when it comes to value transfer networks is very low. And it'll be very true for issuers and investors. They want to ensure that they're really not worried about the risk which is underlying in the infrastructure. So it's very critical that all these pieces are done in a very well thought of fashion if you want to achieve the level of scale you want to achieve.
Hey, Blue, you were at a crypto shop for 5 years before this, and now you're at a firm that's 85 years old, trying to, make it more digital first, focused on digital assets. How do you do that?
Well, I mean, I think that one of the things that's sort of core to T.Rowe DNA is growth and innovation. So growth, like investing in growth strategies. So while blockchain is a new technology, technology itself isn't new to T.Rowe. So, for the past 3 years, we've had analysts who have been really building out robust, foundational, fundamental research across the ecosystem, trying to understand the different pieces and how everything comes together. And I think recognizing that crypto markets have gotten to a size where they will impact and interact with traditional markets is part of what led to the creation of this role. We have one of our analysts, Dante Pearson, who does amazing work in this space. And the way that he sort of explained it to me was that we need to be looking at everything in the early stages. We can't show up when something goes public and be like, let's cover it, right? You have to understand how all these different pieces fit together. And that fundamental research, that drive to understand things, is very core to the way that T.Rowe approaches things. And I think that that's something where there's a lot of overlap with crypto, and I think it is the right way to think about and approach crypto, right? You shouldn't start with answers, you should start with questions.
I like how you said this drive to understand, because I know people who have been driving to understand crypto for years and still don't understand it. And I'll be frank, this stuff is really, really complicated. Sometimes it feels like you're not even qualified to read one of these white papers. Bart, does that concern you at all? I think it's fair to say people understand fixed income, people understand equities, they, to a certain extent, understand future cash flows. But do they understand crypto?
How many people in this room own a mutual fund? How many people would feel comfortable describing the role of a transfer agent in a mutual fund? So it's like two guys from being right? And so how many of us drive a car? How many people could describe what a carburetor does? You do not need to have a comprehensive understanding of this entire asset class.
The only thing I'd say, maybe you understand that mutual funds are made up of a collection of stocks. So you understand sort of what's under the hood there. Carburetor, I can't really speak to that.
Yeah, I think in the world. So yes, I think one of the great things about what Blue is doing is that people do need to be able to consume research in a manner with which they are used to it and can consume it. Where most of the white papers are written by computer scientists and cryptologists and things of that nature. So I think it doesn't concern me, because I think the vast majority of people just need to understand Bitcoin, right? It is a digital currency, non-sovereign, not controlled by any person or country. And then Ethereum, and they need to understand that Ethereum is a platform where a party or parties can execute a contract without an independent third party. That's kind of all you need to know. And then you get into stable coins, you get into non-fundable tokens, you get into all these things. You don't need to understand that stuff to practically understand the value benefit that comes from those two things. And so I think sometimes people get caught up in the minutia, and it becomes paralyzing because it is fluid and it is complicated. But if you just focus on those bite-sized portions, and you can read research that talks about, okay, when is Ethereum going to disrupt payments? When is it going to disrupt real estate? And you can make it a educated investment on those theses, then I think people will invest in it. And that's also within the traditional infrastructure of traditional finance, where you have to remember that Bitcoin was created specifically to offer an alternative to traditional finance. And then people get frustrated when it doesn't fit neatly in the thing it was meant to disrupt. I think a lot of original Bitcoin people think the fact that it doesn't fit into a regulatory framework is a feature, not a bug. And so I think that there is the traditional finance stack where you're going to invest in a regulated marketplace in these opportunities, and then there's going to be this non-regulated DeFi area where a lot of investment's going to go in and is incredibly early, that has a tremendous amount of upside potential, and those two things can coexist in different worlds.
Puneet, I saw you shaking your head, nodding. I couldn't tell if you were agreeing or
I
if you had
think
something
I
to say.
I think the core part of actually consuming research is super critical. We need to build some of these educational pieces which are relevant for people who are investing in this space. Citi has a big research team which actually is focused on this area, driving certain research reports. How do you think about valuations here? Very different. when it comes to this kind of an asset class. If it's traditional assets and if they're like securities, I get it. But should we think of it differently? So that's, I think, a very important piece of engagement in this space, which is to actually start appreciating, as you would appreciate anything else. You don't have to go under the hood in terms of technology if you don't need to, but do understand the characteristics and the risks associated with what you're doing.
Blue, I shared this this anecdote on a recent episode of our new crypto show, Crypto IRL, about how about a year ago I was in an Uber going home, and the Uber driver was, you know where this is going, right? Okay.
It's the same Uber driver. We've all been in that taxi, yeah.
How much terror should I owe?
Right, yeah.
Well, needless to say, I don't, the last time I was in an Uber, the Uber driver was not talking about crypto. And I wonder, with $2 trillion being wiped out and so many people getting burned, if people are just saying, I'm never going to touch this stuff again.
So I don't think that people are, I think a lot of people got burned, and there was a huge drop in market cap, and we saw, a massive sell-off and declines. We saw a number of blow-ups, right? In my mind, so one of the things I find most interesting about crypto and how it's evolved over the past several years is most traditional, almost any asset class you look at, it starts with the most institutional investors, the most sophisticated, sort of this tier. And then as products and capabilities get developed, it sort of gets rolled out on with additional sort of protections and additional, added sort of layers before we start rolling it out to retail. Crypto inverts that entire trajectory. So crypto is the only asset class that I can think of, but where we started, it was like driven by retail. It's like crowdsourced in many ways, right? And you started to get more and more participation. And as far as it's gotten into the institutional participation stage in a meaningful way are sophisticated hedge funds. So what is absent are long-term investors that have, these very long time horizons, that have, ample liquidity, who look at, something and take a very long-term view. And that piece is missing right now. And I think the entire, crypto community, and I think the market, and I think, all of us would benefit from that participation, from that piece.
I think it also, it describes where we are in the cycle, right? Because you have these headlines that, 24 months ago would have moved Bitcoin up 10%. And BlackRock adds Aladdin and State Street and BNY Mellon, and everyone's just yawning, right? So it's just like nothing is going to drive it higher. And over the course of all of our careers, like when buying something felt good, it rarely is, right? Like the times where you invest in things and it feels scary is probably, in many cases, the best investment. So right now, I don't know what news would move it higher, but good things happening along the way, right? So I think if you look at the opportunities in these assets, they're getting better month to month, but the asset prices stay the same.
But the thing is, the track record is different for fixed income and equities in general. So how does a wealth manager go out and say, it's time to add crypto to your portfolio, to somebody who's like, are you kidding me? Look at what happened over the last year. I don't want to touch the stuff. I have no idea if this stuff's even going to be legal.
If a wealth manager has enough conviction to put it into a portfolio and can't answer that question, you probably should have a different wealth manager, right? and I think if someone has conviction on why it is a non-correlated asset that should be 1% of someone's portfolio, right? And so it's kind of a call option that central banks get it wrong, right? So if you own 1% of Bitcoin and it ends up not being worth anything, everything else in your portfolio is probably fine.
Are you just speaking of Bitcoin right now? Or
Bitcoin as a separate,
okay.
Yes.
Okay.
Which is obviously different than the entire decentralized finance and smart contract platforms. I think people should think of those two things separately. They're two totally different things.
How are you thinking about this at Citi, Puneet? I mean, are you having the conversations now about to the wealth managers that say, we have these products available, we are ready for, or we plan to have these products available, we are ready for you guys to talk to your clients about them?
Yeah, I think what Blue said earlier, which is the trajectory which started with retail, went to hedge funds, but starting to just see emergence of real money actually engaging with this. So still the level of demand is still not there because You need a broad set of, for that kind of investors to engage, you need right infrastructure supporting all of this. So what you're starting to see is people wrapping those products in different ways to use traditional rails to give exposure. So you have CME and you're offering futures. You have certain exchange-traded products being offered. So effectively giving ways to get exposure to this, but in a traditionally wrapped product, because that new infrastructure seems daunting, as you said. How do I engage? How do I assess? I have fiduciary responsibility. How do I ensure that I'm not really I'm doing the right level of due diligence around this? What is, and I said earlier, what is interesting is actually a survey which Bonnie and Celent presented yesterday as part of the announcement. More engagement seems like almost, which was surprising to me. 95% of the surveyed real money managers, effectively said they're looking at tokenization, which was also very fascinating, which is that maybe there are new asset classes, there are new ways to engage in certain asset classes, not liquid. There are new ways of engaging and providing exposure to certain asset classes, so that was very fascinating. So it is yet to be seen how they start to engage in this. BlackRock announcement was definitely very big news, and I'm sure we'll engage more. And what we're really seeing is across the asset management industry, typically institutions have now digital asset focused groups and working groups, which are starting to engage and starting to build out and starting to build their engagement model.
I think there's this overgeneralization that happens when people talk about crypto. They think about Web3, they think about the metaverse, they think about all these sort of like all-encompassing terms. Blue, I wonder if there's anything that you would look at the landscape today and basically say, this does not belong with us. This should not be grouped into the crypto ecosystem right now. Like, this gives us a bad name.
I think that there are a number of different protocols, coins, what have you, that were developed with the intent of being a tool for bad actors, right? So, like, I mean, I think Tornado Cash is the one that's probably come across everybody's, like, Bloomberg. You know, I think that those do an incredible amount of damage to the entire rest of the ecosystem. And I think over time we've seen the quality of actors in this space and the purpose that the different coins, or whether it's Bitcoin or whether it's different protocols, have a lot of different legitimate uses, roles, ways to think about them, and I think that the tools that are very clearly meant just for bad actors are deeply concerning. Right, and I think it's been very hard for crypto to sort of shake that image or that brand from the early days.
I think that there are people who are trying to do things that are very aspirational, that are very difficult, that cannot be done in the sandbox environment, right? So, like, the most notable one was kind of Terra Luna, right? And the industry, to your point, doesn't do itself any favors in PR. With many of the most charismatic people who attract attention oftentimes for the wrong reasons. But the idea of having a non-sovereign backed stable coin is aspirational, and I think a lot of people were like, well, why would you need that? But there are people who want to work on this, and again, you can't work on it in a sandbox environment. It has to be in a real world environment to stress test it to see if it'll work. And I think there's going to be a lot of things like that that will lure people because the concept of it is attractive, but the execution of it's more likely to fail than not. And if it attracts people who don't understand the technology, they probably are getting in at the wrong time. So I take it a little bit different than Blue's take, although I think directionally we agree, in that we're trying to do a lot of things in DeFi that are really hard and might not work. And when they fail, the people who invest the money in them are going to fail with them. And I just think people need to understand that.
You said tension, so. And tension between, and there's a tension between traditional finance and DeFi right now. And I think, I just want to read something that you all heard because Jamie Dimon said it last month in a congressional testimony. Quote, "I'm a major skeptic on crypto tokens, which you call currency, like Bitcoin. They are decentralized Ponzi schemes." I'm not going to direct this question to anyone because some of you came with PR people. And I know that would be an issue. Who wants to touch that? Like, what kind of, does that do damage to the industry?
I don't think anyone came here or anyone in this room believes that crypto isn't controversial. Like, I think we're all okay with that. And if you've chosen to occupy this space, like you're pretty used to it. Like everyone at your Thanksgiving table has said that to you at one point or another.
Or maybe in 2017 they were asking you where to buy it.
Right, or like, it's like, oh, your mom told me you work at Bitcoin. It's like, no. So,
is that where you got the socks for at Bitcoin? Yeah.
But I think one of the things I think is very interesting about this time and space and the way that things are different now versus several years ago is, my understanding is that JP Morgan is still in the process of building out, right, the rails. Like they're building out the capability to engage, right? So I think that we've gone from controversial and don't touch it with a 10-foot pole to like controversial and all right, I'll let you see where this goes, right?
Yeah. Regulatory compliance in this country, in this environment is difficult because you have to satisfy, in some cases, conflicting ideas, right? And so there's the SEC and the CFTC, but there's also OFAC regulations, and there's the Treasury Department, there's the Department of Justice, and they all have different rules and regs that you have to be able to navigate, and no one will give you any guidance, right? So, it's easy to take shots at crypto. We don't do ourselves any favors in PR for certain, but it's also interesting that, you see, and I'm not directing anyone, just like regulatory compliance in traditional finance isn't the easiest thing in the world, and there's companies that come out every single year with billion-dollar fines, whether it be there's mortgage headlines this week. There was helping investors avoid, tax liabilities in the United States, and yet, they sit there with righteousness and condemnation for our inability in crypto to navigate that, and it's hard. And I think there's a lot of people who are working really hard to try to build a regulated crypto world in the United States, and we just get overshadowed by these larger-than-life people on Twitter who, maybe don't do the best at describing what we're trying to achieve. So it's tough. I think there's a lot of people trying to navigate it, and it's complicated.
Puneet, do you want to say anything?
No, I think
Okay.
you said it.
Okay. Well, I do have another question for you, though. I do have a
please
question
let it
for you.
come.
Okay. We only have a couple minutes left, and I want to take a sharp turn because you have spent so much time focusing on the Rails blockchain technology. And I've been hearing for the better part of a decade about blockchain technology and how it's going to make our lives so much better when it comes to shipping or knowing that the sushi you're eating is actually, the fish that it says it is. But I have yet to encounter a time in my life when blockchain technology has actually made it better. Am I wrong?
It's been really 10 years since this technology has been in existence. So it's been just 10 years since this technology has been in existence. It's not that it's been a long time. Some of the credible use cases, and people ask that question all the time, what are the credible use cases? How can we think about, so obviously there's a whole crypto universe, and this is a whole kind of experimentation going on, and that's big in size and expanding. What are the other credible use cases? And I always point out a few. We've been working on something which is post-trade derivatives for equity swaps, and pretty intensive now because a lot of sell-side firms, buy-side firms, names like BlackRock or Citadel or HSBC, Citi, Bank of America, effectively coming together and saying the post-trade activity for derivatives in equity swaps is complex. It has a whole life cycle. How do we reconcile? Actually send each other Excel spreadsheets and emails. Could we actually figure out a way to replace it? So actually building ecosystems are always hard. So this is an example where now a significant amount of activity is actually flowing through that. Trade finance is another example. Contour, Comgo, two consortiums. Looking at trade finance where you have shipping companies, ships, importers, exporters, all on different wavelength and different ways of communicating, country by country, all coming together. So those are some interesting use cases we're starting to see. But still, like if you think of this evolution, there are POCs, which are proof of concepts. You do simple examples and you do one or two trades, etc., to scalability, to interoperability. I think we're somewhere like between POCs and scalability. That's kind of
all I want is for when I go to a new dentist, the old dentist to be able to send my x-rays to the new dentist. Like, is that too much to ask without faxing something?
That's also very fascinating. We announced something with Swift, we said, how do we consume Swift messages? Because you cannot have the whole world isolated. How do we consume Swift messages onto a blockchain platform? So Swift ISO messages coming into and in a tokenized form, and how do the two communicate? So that's another big piece, which is actually to bring your old dentist and the new dentist and records to move together with it. Absolutely.
All right, we're going to end it there and go to questions from all of you. I saw your hand go up first.
Yeah, JP Morgan, and Jamie's very interesting. Oh, thank you. Thank you, JP Morgan. Jamie's very interesting in that headline. And I'm in the institutional industry. We got to be institutional. You know, we like some of the concepts of growing and being bigger, and the future's big. But how can institutional investors, we're talking, you know, Harvard Endowment, we're talking about CalPERS, how can they get comfortable with this space today? Tomorrow's better. We're looking ahead to the world, but today in this quarter, with the markets the way they are. Thank you for a great panel. Thank you.
I mean, I think it's up to each. You know, if you have like CalPERS and an insurance company, right? They have an investment time frame that by definition is longer than a lifetime, right? So I think that if you have an asset class that you think adds value from a correlation standpoint, and they all have different investment theses, I think that the liquidity in Bitcoin is there for anyone who wants to use it, right? It's just depending in the spot market and the futures market, it has enough liquidity to handle virtually any kind of institutional investor, and it's just a question of do they value it. So I'm not, it's not my role to convert the unconverted, but I'm there to basically say, like, if you want to do this, and the investment merit of these assets is not my business. I'm in the business of providing liquidity, and I can walk you through how I might be able to provide liquidity for you in a way that suits your needs, and that's kind of where I have to leave it.
I think we have a microphone too, so I want to make sure. Oh, there we go.
Thank you
Hi.
so much.
Mylan Suter, thank you so much. It's a great panel. I have a question regarding, we're long-term investors here, and when it comes to investing in crypto, why would I allocate a part of my portfolio to something that has no backing, has huge standard deviation, and it has several years since its existence fell 50% or more, versus in equities where I know, there's a hard asset there. Even in commodities, there are hard assets there. From a portfolio management perspective, why would I allocate to something that's so volatile that in 5 years from now could be in the same place it was 5 years before?
I think that's a totally valid point of view, right? It's a totally valid question. I think one of the things that is important to differentiate is like the difference between Bitcoin and assets, right? So that's the first one. And what we have now in the asset space, like layer ones, layer twos, right? Things built on Ethereum. We have a functionality that didn't exist 4 or 5 years ago. And this is where a lot of the really interesting development activity is taking place. So I think that you can make an evaluation about whether or not, what value you want to put on that functionality, but there's something to work with now. And that isn't true in the same way for like Bitcoin, for example. Bitcoin, I think, is much more of a macro play and a macro viewpoint. And you may assign no value, right, to that functionality, and that's totally valid. So I think it's about developing a framework that makes sense within your own portfolio management style with your mandate that looks at how do I take this functionality, how do I try and recognize the value, how do I capture that alpha in essence, and like where do I think this technology leads, and how do I think it builds 3, 5 years, 10 years out.
We have microphones going around, so.
The Fed came out and talked about they're not going to make any moves or any action until Congress does. So during the whole discussion throughout the day, we talked about crypto, we heard, but no one's talked about getting congressional or Senate either approval or input. So how do you expect crypto to move forward if you don't even have our senators or Congress people talking about this? Because at the end of the day, whether it's the stock market with equities or the commodities market, Congress has always acted and put laws in place to regulate the markets. So how do you get around that?
So Senator Lummis and Gillibrand of the great state of New York have put a bill forth that I think has gotten a lot of good critical review, and they're going through that. I think there's some bills that might get put through before this end of this session that's being considered, and I think that if something was in there, that would be very beneficial. But there are a lot of senators out there and congressmen and women that are talking about this. Senator Toomey had talked about this at length, and I think that there is a lot of congressional support around it. It's complicated, and trying to put that into they are in the hardest spot in D.C. because they have to deal with all of the other agencies, whether they're enforcement agencies or the regulatory stature of the CFTC and the SEC. So I think I don't think that there's not activity around it. I think they're just trying to be very prudent about putting forth laws that will satisfy all of these other agencies that have to operate around the outcome of those laws.
Do you think that the passage of MiCA is basically going to change that?
In Europe?
Yeah.
I don't want to get too far out of my realm into European regulatory structure. I mean, I think in Europe, it feels like most countries are waiting for the outcome of that before the FCA in London and other major financial centers around there, Amsterdam and Dublin. It seems like they are all looking for that guidance that MiCA would create. And so I think to a certain extent, you're in a similar boat there, yes.
But will it move assets from here to there? Or will it move players from here to there?
I mean, there has been a lot of discussion over the years over kind of like regulatory jurisdictions, right? So then you have like traditional places where like fast money hides, right? Like Cayman and BVI and stuff like that. And then you have the real money centers, London, Singapore, Hong Kong, New York City. And it is a difficult thing to pin down because it's so fluid. So that, London looked like a very bad place, and then it was very constructive, and now it seems like they've had some changes over there, and it's still kind of in flux. Singapore is another one where there was a lot of focus there. Hong Kong was a big draw, and so the fluidity of where regulated businesses will house their crypto endeavors and how they're going to be able to work within those regulatory landscapes, and then you have like just global regulatory is incredibly difficult to pan out. Yeah.
He vetoed it, right? He passed it.
We have time for one more question that I just want to make sure.
Right here. I've got it right here.
Okay.
Bart, Puneet, Blue, when does the Fed blink, and when does crypto diverge and decouple from traditional asset markets?
Well, I can't speak to Fed policy. That's where I actually have to draw the line.
Yeah, I'm married to a former central banker, and so I'm not going to answer that.
Former central banker,
right.
so it's fine.
Right, yeah, it's fine. Right, like don't tell the other crypto people. But yeah, so I think that's a very difficult question to answer it. And one of the things I think is very interesting is that a year and a half ago or 2 years ago, we thought of many of these crypto, like we thought of crypto as an inflation hedge, right? And now it's like, well, is it it doesn't appear to be functioning as an inflation hedge, right? And I think, so that decoupling, I think, is something that will change and evolve as the market itself changes and evolves, right? And I think it's also very much driven by the participants who are actively trading in the market. And so I think it is not just the Fed that is it's not just what happens with rates that's going to drive that. I think there's an evolutionary component to the market itself, and it will go through phases where it trades in tandem. And I think we've seen a lot of other things trade in tandem as well. I mean, I come from an EM background, and we always talk about when things go wrong, like correlation goes to 1. And so I think decoupling is an evolutionary process, and I don't know where it ends up.